and welcome to another edition of Aviation This Week. I am Bukola Koka, standing in for your usual captain, Bukola Joe Ketumbi. On the program today, the Chief Executive Officer of Waka Now Nigeria, Mrs. Adenike Macaulay, speaks on the impact of trapped funds of foreign airlines, the launch of Nigeria Air on the national aviation industry, and other matters.
The first and major effect, of course, apart from the effect on the airlines having their funds trapped for months, at this point, months on ending, but the major effect would be on the customers, and that's increasing average ticket prices. Since I think this issue started a little over a year ago, towards the first quarter of last year, and what the airlines have had to do to sort of hedge against the impending risk of having their funds trapped for an undefined period, and those funds being trapped in Naira, and with the weakening position of the Naira, it means the value of their funds in foreign currency, of course, begins to deplete for the duration of the period that it is trapped. What the airlines have done to mitigate against this impending risk of funds devaluation is really to not increase their prices, but to restrict access to the low ticket inventories in the market. Now, I would use a simple example. If the average fare from Lagos to London is $1,000, so airlines file their fares in USD, regardless of point of commencement. So if you're buying from the UK, the US, South Africa, it is always $1,000 flying from Lagos to London. Now, to buy it in different points of sales, it would be based on the BASA, the bilateral air service agreement between the country of the point of sale and the home country of the airline. So in this case, between Nigeria and the UK. And the BASA would ensure that the airline is actually bound to sell in local currency. In our case, which is Naira. So that's $1,000. They sell it at a rate that is regulated by IATA, the International Air Transport Association. For the sake of simple maths, would peg that at 100 Naira to $1, which means an airline sells $1,000 out of Nigeria today. It is 100,000 Naira at 100 Naira rate of exchange. Now, if somebody is purchasing that same ticket from the UK or from the US, the person pays in pounds in the UK, person pays in USD out of the US. The airline gets their funds immediately, no issues of repatriation. Now, in our case, the airlines have seen that their 100,000 Naira, which is meant to be pegged at $1,000 in value based on the IATA exchange rate, is not always $1,000 at the end of the unending months of it being trapped with the CBN. And even over and above that, when they go into the I&E window to bid for repatriation of funds, the I&E window is where most of the investors in Nigeria and foreign investors go to bid through their banks to access their funds at the agreed CBN rate. Now, the same BASA that kind of binds the airlines to sell at this defined rates also binds the Nigerian government, the CBN, to make Forex available to the airline at the defined rate of 100. But the airlines have seen that as they bid, the rates that they get from the I&E window is a bit divergent from the CBN rate. So which means that the value, 100,000 Naira, that they expect $1,000, starts to become 950, 900, 800, and as the gap between that rate and the parallel market rate begins to extend, the risk for the airline begins to get larger and larger. Right now, the gap between the IATA rate and the parallel market rate is around 60%. So today, the parallel market rate is around 750. The IATA rate was just actually last week increased from 462 to 551. So it has reduced the gap a bit to 40%. That's some of the things that came out from the meeting with the Ministry of Aviation. But still, there is this huge gap, which is the risk that the airlines see selling in Naira. So what they have done is to take out those low ticket inventory that puts them within a profit margin that does not allow, should that devaluation risk become a reality, which means should they lose today 40% of the value of that naira that they have trapped, should they lose the value in USD based on the exchange rate being merged to the parallel market rate, which is what we see that has happened last week. So last week, like I said, the rate was moved from 462 to 551, closing the gap a bit. So which means that airlines that did not make the decision to start restricting inventory already lost 20% of the value that they had trapped just last week, just by that adjustment that was done. I'm in an interesting position in this whole thing because I spent a couple of years on the airline side at Lufthansa Group. And in 2016, we were in this same position with trap funds. It didn't span this long, but we're in this same position, and I understand the rationale for the airlines to make the decision to hedge their risk a bit. Should they need to look towards the parallel market to repatriate their funds, then it would be at a huge loss to them. Airline margins are, on the average, 5%. Yeah, so which means that is the risk window that they actually have to play around with. But if they're operating in a market where they risk losing 40 to 60% of the value of their ticket sales, then they have to make the decision to hedge against this risk. And what have they done? Reduce access to low ticket inventory. So what does that mean for the customer? The ticket that was costing them $1,000 last year, which is 100,000 naira last year, now costs between 150 to 200,000. Now, they did not increase the fares, which means that a customer can still go to the UK and buy that ticket for $1,000 if you have dollars. You can go to the US and buy it. You can go to the UK if you have pounds, go to South Africa and buy it if you have rand. But if you're going to buy it out of point of sale Nigeria in naira, they've closed down the $1,000, $2,000, $3,000. They made available only the high, we call it RBDs, high ticket RBDs, high fare RBDs. They are more flexible, of course, there is much more value, but we know that the majority of the market typically goes for that lower fare range, which are more restrictive. But at the end of the day, giving the customers the flexibility of choice across all the available fare structures that the airlines have is what has been restricted now to Nigerian customers buying in naira out of Nigeria. So the real impact on travel as we know it is really an increase in average ticket prices of between 50 to 100%. Some have even doubled at the minimum, based off of the difference between what is available now and what should naturally be available from the airlines is about 50%. And the customers today bear the brunt of that, unfortunately.